So the story to today's video is really about the very massive breaking news that the Federal Reserve has now officially, and it's expected that they're going to be continuing doing this again over the next couple months, officially now cutting interest rates once again. They officially in the most recent meeting cut interest rates by specifically 0.5% above the estimated originally 0.25%. So a lot of people thought that they were going to cut it by 0.25%. In the end, they ended up cutting it by 0.5%, which is very massive breaking news, because aside from the fact that it went over the estimates, what this also means is that it's officially going to be the start of the federal pivot. So in other words, the Fed pivot. The idea really behind this one is that this is very big breaking news. Why this is so important is that it means the monetary policy, it's going to create an easier monetary policy once again. This is going to have a massive impact to our daily lives. So whether you are someone that's an investor in the stock market, if you are invested in stocks, retirement accounts, hopefully, bonds, investments, the housing market, the job market, looking for a job, if you are someone that's currently in the labor market and you're trying to find a new job or you're trying to upgrade your career, anything in that particular world, this is going to be very impactful. It's definitely going to have a massive impact to inflation, which I know is one of the biggest concerns that a lot of people have had over the last couple of years. But the idea is that in today's video, what I really want to talk about is essentially outlining how this is going to impact everything. So hopefully if you watch through by the end of this video, it's all going to make a lot of sense. There's some really great news to all of this stuff that's about to come, but there's also some bad news that I think is really important to share, because again, the economy is not always black and white. It can be a little bit of a gray area depending on the specific topic that you're talking about. But with that being said, let's just get right to this video. Like if you guys enjoyed these videos, comment, subscribe, feel free to leave a comment about honestly anything. And with that being said, let's get this video started. So in order to really be able to understand what's going on today, I think it's important to maybe try to start this video by talking a little bit about the history and the background story to what really led us to be able to see or be where we are currently at today. The idea really behind this is that for the last several years, the Federal Reserve was spending a lot of time increasing interest rates in order to fight inflation. And the long story short is that the impact is that this led, and again, I'm just being very straightforward here, is that it's very fair to say between all of the problems that we've been facing, from inflation to increased prices to the very difficult job market, is that it really tanked the economy. A long story short is that it led to a pretty horrible economy that we had to face and deal with for the last several years. You guys can feel free to comment down your personal thoughts below, especially if you guys have a story maybe to share about how this has impacted your lives. But I can certainly say that the most difficult thing about it is that because of the increased prices, it has made it very difficult to live, to be able to afford goods, to be able to buy groceries, to be able to pay for basic bills. This is actually especially true because on top of that, because we've also had a very horrible and difficult job market, this probably depends a little bit on your industry, but for many particular industries, certainly like tech, in the media industry, in entertainment, in a lot of other industries, the idea really behind this is that it was very difficult to make money because of what was going on. So what this really means is that while prices were increasing, people were also making less money. This is a double negative way to be able to really improve life. That's a really difficult situation to be in when you see these prices skyrocket, but the wages are not keeping up with inflation, or in some cases, people are making even less money than they were before the pandemic, depending on the specific industry that you're in. So this is really what's going on. Now, the goal going forward for the future is that what they're really going to try to do now is that they're trying to decrease, or they're trying to lower inflation so that it's trying to hit the target of about 2%. Originally, back when they started doing all of this fighting inflation. So like originally when they were doing all of this interest rate increases, I believe the inflation rate was a little bit over 5% or something above 5%. And now currently at the time that we are making this video, it's a little bit under 3%. So they've made a lot of progress, which is the really, really great news. But the goal is that they're trying to decrease it so that it goes down to about 2%. Now, I think it's really, really important to kind of understand is that when they are talking about decreasing inflation, what they are talking about is that they still want some level of inflation. They just want less inflation. So why do I think this is so important to really be able to understand is that a very, very common misunderstanding is that they're going to be trying to fight inflation by decreasing prices. At the current time period, it is very, very unlikely prices are going to go down in the sense that things are going to get cheaper. What they're really trying to achieve is to make it so that the prices still go up, but they simply just go up less. So in other words, originally we were having prices spike up. They're still gonna go up, but now we're trying to create a curve so that they still go up, but they're just gonna go up less and less and less and less, and specifically with the target goal of going up by a rate of only about 2%. So that's really the goal that we're trying to achieve right now. And because the Federal Reserve sees this as finally the opportunity to do so, they are now officially doing something called the Fed pivot, which is when interest rates are now going to start to decline again. And that's going to be some good news and also some not so good news, which we're going to get onto. So definitely continue watching and stay tuned for that. But with an easier monetary policy, the bottom line, then the biggest takeaway is that it means that we're going to see a lot more money flow back into the economy again. Now, why is this particularly important and how is this going to impact the future? Let's just break this down into different parts by starting to talk a little bit about the stock market and about investments in general. So how this is going to impact the stock market is that historically, based off of past data, what ends up happening when the Fed pivot happens is that we start to see stocks actually decline, interestingly, in the very, very beginning, because a lot of times the reasoning for this is that stocks start to price in the fact that the Fed pivot has officially happened, and it also leads to a lot of just unshaky moments because we are seeing changes. And as we know is that the stock market is sometimes very, very influenced by the amount of changes that happened in our economy. But the really, really great news, maybe to share one really, really bright news that might come about this, is that in the long-term game, stocks are now expected to go up again. This is actually really, really similar to what we saw in 2020. If you guys remember during the pandemic, when they started to print lots and lots of money, but as a result, it also means that we had an easier monetary policy. But as a follow-up to that, that's also part of the reason why stocks, despite the fact that people were out of work because of the pandemic, people were struggling, but because of the fact that there was an easier monetary policy, we saw stocks soar and spike up very, very high. So that's really the story behind how it's going to impact the stock market. Now, there is some really, really great news about this, and it also means that there are certain moves that you can potentially make to take advantage of the situation, which we're going to get onto in a little bit. But maybe moving on to talk a little bit about the housing market, is that it does mean also the other relative just general news is that housing prices are expected to start to not come down, but just go up less. And the logic behind why this is the case is that because if people start to have more money because of the monetary policy situation, then what it really, really means is that people are going to have more money to be able to spend again. And if people have more money to spend again, this includes not just putting money into the stock market like we've already mentioned, but also putting money into the housing market. But what this is going to mean is that it means that housing prices are still going to go up, because again, if people have more money, then they're going to buy more real estate, so prices are going to go up just out of that logic. But it does mean is that because they're still controlling inflation, they're just not going to go up as high as what it was for the last several years when we saw housing prices spike, going up very, very drastically, making it so that home affordability was simply put just pretty horrible, actually, because a lot of people could not buy a home at that time period because of everything that had happened. Now, let's talk a little bit about the job and labor market, because I know there's a lot of people, including myself in a lot of ways, that are currently on the hunt for a brand new job, or certainly at the very least in a situation where they're trying to upgrade their careers. One really great news about this is that it does mean that because of the Fed pivot, that the job market is expected to improve and get a lot better. Why this is the case and what's the logic behind this is that because there are a lot of companies that run off of a loan of some kind. And if interest rates were to decrease, what this really means is that it means it's going to be a lot easier now to borrow money because it's going to be a lot cheaper. This is especially true for a lot of startup and brand new companies that are literally borrowing money to keep their businesses afloat. What this really means is that because if people start to have more money, they can start to spend more money as well and pump money back into the economy. And if more money is pumped into the economy, it means that people individually have more money to spend, which means that there's going to be a lot more productivity. In other words, money is going to flow a lot more faster and a lot more greater than what was the case when they were doing the Fed, the interest rate hikes that made it more difficult to borrow money. Because money is going to be easier to borrow, it means people are going to be able to spend more money, which means that businesses are going to start to improve again. And if businesses start to improve again, it means that they're going to be able to hire more people once again. And if businesses hire more people once again, this is going to create a lot of jobs. This is going to be really great news, because it means that jobs are going to be created. And hopefully this means that the actual unemployment, and why I say the actual unemployment is that because if you've watched past videos, you know how we talk a lot about how the unemployment rates can be a little bit misleading because they're kind of manipulated a little bit and skewed based off of how they define the word of unemployment. If you guys have been around, maybe consider subscribing, if you guys haven't done so already, because again, we are going to be making more videos, hopefully to try to keep track of everything going on. If you guys are interested, consider subscribing. But the bottom line behind this point is that because businesses are expected to do better now because of what's going on, it does mean that more jobs are going to be created, and it does mean that it's going to lead to an improvement in the job market. It means that unemployment hopefully will fall again. It means that hopefully we will see a much better economy, and it means that things are hopefully, at least in this particular area of life, expected to get a lot better. And I think that that's maybe one really great news about it. Now, maybe to talk a little bit about what are some of the bad news that's actually going to happen because as a result of everything that's happening. So the first bad news about it is that it does mean that because we are leading to an easier monetary policy, it means that people are going to have more money. What this also does mean is that inflation may be at risk of going back up again. It's probably the foresight is that because they've already spent so much time fighting it, it means that it may not go up as much, but it does mean is that it may reaccelerate once again because of what's been going on. The logic behind this is really not that different to what happened in 2020. If you guys remember back in 2020 when they were printing so much money that prices were starting to skyrocket and spike, they're probably not going to be printing as much money because I think that at this point the pandemic is over and they've probably already learned their lesson from what happened in 2020. So, but at the end of the day, there is a risk that if they cut too fast, inflation might start to reaccelerate once again. The other not so good news about this is that while it is true that it's going to be easier to make money off of the stock market, it does mean that because interest rates are going to go down again, if you are someone that has a lot of money parked in a high yield savings account, interest rates are going to go down, meaning that you are going to be making less money from your savings account once again. So that is just some maybe not so good news to really be able to get out there. But I think overall is that there's going to be some great news and there's also going to be some not so great news, just depending on how you look at the situation. Feel free to comment down any personal thoughts down below in the comment section. But in terms of now maybe looking forward into the future about what we should do from here is that at this current point in time, I do believe that because of what's been going on, it does mean that this might be time to start to invest in the stock market again and start to rotate money inside of there. Because if stocks are expected again in the long term to go up, then this is going to be really, really great news for our investment portfolios, for our retirement accounts, everything in that particular world. Things are expected to get a lot better. So that's the really, really great news about it. It does also mean that if you currently have some level of money parked inside of a savings account, it might also be time to maybe try to move some of that money into a high yield CD so that you can lock in those high interest rates while they are still high before they go down again, so that you guys can try to maximize and get the most amount of money from the money that you guys currently have outside of investments. So specifically money you have in a savings account, maybe park some of that money that you don't necessarily need in the immediate future into a high yield CD, and so you can get those really, really nice interest rates. I believe at this time many high yield savings accounts still offer around 4% interest rates when it comes to how much money is going to come back. However, we don't know how long this is going to be, especially again considering the fact that they're expected to start to cut rates again over the next couple of months. But at this current point in time, this is something to maybe take advantage of. But of course, in terms of what else is there to know for the future, we just have to see in some of the future episodes of The Kevin Show, or this show. So with that being said, that's really what I wanted to cover in today's video. So if you guys enjoyed that, thank you guys so much for watching to the end. Maybe consider subscribing, hitting the bell if you guys haven't done so already, smashing the like button, feel free to leave a comment. And with that being said, thank you guys so much for watching. As always, stay safe, stay well, and hope to see you guys next time. Thank you guys so much again.